Okay, everybody, it's me, Gregory Mannarino. Sit the freak down and freaking relax. We have a lot to talk about. I am going to set you up with this video blog. If you're one of my lions, like you have no idea. And if you're not one of my lions, you're just one of my really dear friends, or you're a stacker, or you're someone that holds crypto, pay attention because I'm going to get your back as well. All right, so as I said, this is my newest segment, or maybe I didn't say it. This is my newest segment of Markets, a look ahead on this Sunday, February 13th, 2020 freaking 2. Bear with me a little bit. I had a very freaking bad night. I picked up some kind of food poisoning late last night, and it was not pretty. Honestly, I wouldn't wish that on my freaking, worst enemy, but I was not well last night. I barely slept. But that did give me a chance to think. Let me put a perspective on some of this for you. People are afraid, rightly so. I'm going through my emails yesterday, today, this morning, and look, there's a lot of people here that are long this market, rightly so. Absolutely. You want to be short this market? Good luck. All right, but I'm going to tell you what you should be doing here to protect your portfolio in the event of a shock. I've already explained to you for, a very, very long time that you should have your portfolio hedged, meaning you need to be in risk-on assets and risk-off assets at the same time. Long the stock market, more specifically, you know what I'm going to tell you, as core positions. What do I mean by core positions? Companies that you want to own for the long run, that you would be happy, for example, if they were to fall. So you could buy these and get these at a better price. You understand? Large cap, dividend paying stocks. Very, very simple. That's how you take advantage of the market on the long end, meaning going higher. At the same time, you're hedged by being in risk-off assets, meaning, you know what these things are, physical gold, physical silver, more specifically, and yes, in my opinion, cryptocurrencies. I already explained to you what we're actually looking for. The reason why we are positioned in this way is very, very simple. We're trying to take advantage of whatever this freak show, or whatever the freaks that run the freak show are going to throw at us. So by having our portfolio hedged, we can withstand blows or shocks to our portfolio and just ride it out. You understand? It's very, very, very simple to me, at least it should be to you. You never, ever, in my opinion, want to be all in on any one thing, because you're leaving yourself massively exposed to a shock to your portfolio. So this is why you stay spread out. Okay, you stay spread out. So again, what we are doing, those of you that have been with me for a long period of time, you already know, we are preparing ourselves for the inevitable meltdown that is going to occur, and I mean meltdown, that is going to occur in the debt market. The debt market is the driver of everything. It's the Federal Reserve running the debt market. You all know that. They're buying everything in sight, including the stock market. It should be a no-brainer to you. You all know that. Debts and deficits hyper-ballooning, the Fed's balance sheet, with no end in sight. So we want to be on the opposite side of that, but we want to take advantage of it. So by being hedged, long the market, holding core positions, you know what these are for the most part. If you follow this blog here, I really do like the banks today in this spot. JP Morgan, Goldman Sachs, Bank of America, they pay nice dividends here, and I believe they're going to be able to weather any kind of storm that comes down the pike. So in many ways, that's kind of a safety play to a certain degree, but at the same time, you're weaponizing the system. Do you think, for example, I want to support these institutions? No, but you're not supporting these institutions. You're supporting yourself. You're allowing the freak show to benefit you. That's what it's all about. Okay? The biggest thing I think that a lot of people don't realize is we all participate in the slave system. We all participate in the beast system by transacting in fiat currencies. We're supporting the central banks and our loving, caring, policymakers. They want you in that system. They do. If we could circumvent that And there is a lot of opportunities to do that. We could kill the system, but there's not enough of us to do it. It's very, very sad. But anyway, like I said, when we get that inevitable meltdown in the debt market, we're just going to see cash move from one set of assets into another. Commodities are going to explode, in my view. People aren't going to believe what's going to happen to the price of physical gold, physical silver, platinum, palladium as well. Crude oil, other commodities are going to go parabolic, and I sincerely believe you're going to see the overall market capitalization of cryptocurrencies balloon, which means they're going much, much higher. Expect volatility in the crypto space. If there's one thing we've all learned, okay, it is volatile, but it's not for everyone. If you can't handle that volatility, if you're going to bitch about it and cry and whine, stay out. All right, but at least you need to find a way to keep yourself hedged. With that said, people, we have this issue. Russia, Ukraine, it's everywhere. Every freaking where. People are afraid. Like I said, my email box lighting up like a freaking Christmas tree. Okay, so let's talk about what we can do to protect ourselves against a real shock to our portfolio. First of all, you should be hedged, like I told you. That way you can weather these things. But if you want to take further advantage of the potential of a big hit to the stock market and a spike in energy, look, if in fact something happens over there, I already covered this on Friday, you can expect a global energy crisis to hit us. Now, do you believe for a nanosecond, really, that this would be by accident? Nothing is by accident. Why do you think, and I covered this last week, there is this emergency meeting of the Federal Reserve Board of Governors? Do you really think it's so they're talking about a potential rate hike? They're going to do an emergency rate hike, which would be a stunning admission that, well, they're behind the curve. The Federal Reserve is the curve. They're not behind the damn thing. They're driving the global economy and the markets. They're pulling it in the way they want it, okay? The surging inflation is by design, and we are not done. The Fed is going to continue to buy it all. What a great opportunity, yet again, for central banks to fulfill their end game than to actually have the outbreak of war and create a massive global energy crisis, which would further destroy the middle class. That's what they want to do. At the same time, they want to prop up corporations, okay? Because, the corporations, the Federal Reserve, they're the government, okay? We don't have a representation anymore. The small business guy or girl, well, you're all but dead, okay? It's a corporate agenda being fueled by runaway central banks, none more so than the Federal Reserve. I think you are all crystal clear on that because I've covered this at length to the point of nauseum. Now, if we understand, you and me, that in the event that something breaks out of there, an actual conflict, the stock market will take a hit. It will probably be substantial, but it will be temporary. I would expect the fear trade to play out. And how would that look? You would see the 10-year yield drop substantially, the dollar rise, and stocks sell off. Fear in the market for us lions, okay, means opportunity. Fear is a very powerful thing. Why do you think, for example, the mainstream propaganda ministry, they are determined to keep people in some state of fear, constant fear, whether it's this thing or that thing or the other thing? They want you afraid. When you're afraid, you can't think straight. They know that. It's the biggest mind screw in the history of the world. This is why I tell you all the time, don't get rattled. Don't buy into the fear nonsense. And when you see fear playing out in the stock market, you strike. It's that simple. It's that simple. Now, I told all of you on Friday, we had this dip in the market. The banks actually got hit a little bit. And I've been foaming at the mouth, literally, hoping that the banks would fall. People, before we had this sell-off, like last Wednesday, I said something is about to happen. I had no idea what it was. I said, be ready for it. What did we have? That was on Wednesday. Thursday, we had one of the Federal Reserve presidents, bullshit, come out and spook the market by talking about the Fed being aggressive. Market didn't like that. And then we had this escalation. I'm not over there, so I have no idea what's really going on. The issue over there in Russia, Ukraine is escalating, and that hit the market too. Okay. But for a long time, prior to that video, I was explaining that this market needs to give back. We've gone virtually straight up since the recent low. That's not normal. It's not normal. Markets go up, they drop, find a new floor, and go higher. Okay. We take advantage of these pullbacks. Okay. We've been doing this, you and me, for a very long time. And to say the least, it has worked. It's going to work until we get that implosion in the debt market. Okay. We're not guessing, you and me. Okay. Oh, buy the dip is dead. Yeah, I hear this all the time. And these people have been wrong year after year after year. They're losing year after year. They're allowing themselves to get destroyed by the system, but not you and me, because we know where to look. Okay, it's the debt market that's the driver. The stock market is a derivative of the debt market. Realizing that, our life couldn't be easier. Realizing that we need to be our own central bank, betting against the debt. Now let's go back to our portfolio real quick. How do you and I, anybody, protect their portfolio from a real shock? It's the easiest thing on the face of the earth. And I'm sure my lions already know, but at least most of them. But let's talk about it. So if we understand that there is a potential for a conflict over there, okay, and whether or not it happens, we'll see. But we always have to have the high ground. So we need some insurance here, a way to insure our portfolios, and it's not hard to do. So sit back, take a deep breath. You ready? I'm going to tell you how to do it right now. So if you know, and I know, bullets start flying, stock market's going to fall, your portfolio, at least on the long end, could potentially take a hit. What do? You hedge it by buying puts. For example, for every 100 shares of stock that you own, a company that you're invested in, no matter what it is, you can put it all. If you own 5 companies, it comes out to 500 shares of stock, okay? For every 100 shares of stock that you own, you buy one put. One put of what? I would say the overall market, and you can do this via the exchange traded fund, the ETF SPY. Oh, wow. Isn't that nice and simple? That's exactly how you do it. People, look, you know I am a net seller of options. That's what I do. I played the buy options game for many, many years. I was extremely successful at it, but as I got older, I become more worldly and mellow. I decided, hey, you know what? I want more steady gains. I don't want these wild swings in my portfolio. And I've covered this at length. So I've been a net seller of options for a very long time. But in this instance here, we want to take out a little insurance against the portfolio shock. It's very simple. Like I said, sit down, relax. For every 100 shares of stock you own, you will buy one put on ticker SPY. Now, let's talk further. I would suggest if you are going to do this, okay, again, buying one put for every 100 shares, you do these about 5% out of the money. So it's a cheap way to insure your portfolio on the long end. Now, this is another thing we're going to do, you and me. Okay, very, very simple. If we also realize that energy has the potential to super spike, well, same thing, but with a twist, all right? For every 100 shares of stock that you own, you are going to buy one call of ticker XLE, or the energy sector. So we are hedged from two sides. You understand? How many times have I told you, I don't care what they do. You and I are invincible. We're going to play this game way better than they think we're able to. We can't be beaten. We can't be beaten. Now, let me cover this one more time. For my lions out here, it's just so simple. I say it. I'm just going to say it. For every 100 shares of stock that you own, core positions here should be, what should they be? Large cap dividend paying stocks. Okay, every 100 shares, you are going to buy 5% out of the money put on ticker SPY. Now, to take advantage of the other side, energy, you're going to buy one call. Got it? One call for every 100 shares of stock you own. Again, 5% out of the money. Simple enough? I hope it is. This way, okay, what should your expirations date be on these? I would buy these relatively soon because I think if something is going to happen, it's going to happen out there relatively soon as well. So, I mean, 2 weeks, maybe your options should expire 2 weeks away. If you want to be extra safe, say a month. It depends on your risk tolerance as well. Now, I don't want you to be throwing money away here. Understand what you're doing. By buying these options, like the way I just said, you're essentially insuring your portfolio from a shock, okay? And then in the event that this would play out, let's just say, tomorrow, the next day, whatever, the market decides to drop, your puts that you bought would pay off pretty nicely, and your calls would pay off pretty nicely with energy, and you would pull those profits as the market came down, and you could use those profits to add to core positions. You understand? Now, in the event that it doesn't play out, it doesn't cost you too much money. Because let's say the market continues higher, okay, you lose a little bit of money on those insurance policies that you just took out. Again, to protect your portfolio. Most of you have homeowners insurance, car insurance, whatever insurance. It's the same kind of thing with your portfolio too. So there's a lot of ways to play this game. And like I said, last night when I was kind of, had my head hanging over the toilet, wasn't very fun. I got to thinking and I said, this is what we could potentially do. Now, I'm not saying here that this is what you have to do. Okay. I just want you to realize that you have choices as to what you want to do or may do to your portfolio to protect it if you feel that's the way to go. Some of you might just want to ride this out too. If you're long the market and you're in companies that you want to own for the long run, okay? You're in company XYZ. You love company XYZ. Company XYZ is paying you a nice fat dividend every quarter and you're just really happy with it, okay? This is me with a lot of my positions too. Okay, so if the market does drop, you smile because you believe in the company, you want to own it, so you buy those shares, you add to your positions, getting it much cheaper. And I already told you that's what I'm doing. I am doing that. I will be, if in fact this market falls because of an armed conflict, I will be buying core positions, banks more specifically, all the way down. All the way down. And I will do that until we see an uncontrolled spike in the 10-year yield. When we see that uncontrolled spike, 2%, 2.5, 3%, 3.5 rapidly, then we know that's it. Then we know the debt market implosion has started. And we get to freak out. We pull our core positions even at that point. Honestly, I probably would consider doing that. We stay long our risk off assets. And we destroy the market. We line our pockets with more cash than you could possibly stuff in them. That's what we're going to do. And like I said, I believe when the debt market implosion occurs, we're going to see the market capitalization of cryptocurrencies balloon. And for us people out here that hold cryptocurrencies, I think it's another way we're going to make a lot of cash. Anyway, that's the scenario I see playing out for the market. I outlined for you what you should be doing here, or at least thinking about how to hedge your portfolio against a shock. You understand? You're already there. I mean, if you're with me, like I said, you've hedged your positions already. You don't really have to do anything. But if you wanted to take out a little insurance, Well, I just told you how to do it. Buying a put means you're betting the market's going to go lower. Buying a call means you're betting the market's going to go higher. Okay? So if you're buying a put, okay, against the S&P 500, you believe the S&P 500 is going to fall. If you're buying a call against the energy sector, let's say ticker XLE, you're betting energy is going to skyrocket. You understand? Very simple. This whole thing is not rocket science. Anyway, you got it. I think I got you covered on this. Please do me a favor. If you haven't noticed, YouTube has actually kept their word, which is a shocker to me. They do not seem to be screening comments, at least like they were. So if you could, for me, place comments here in this video. Tell me what you think about what I covered here in this video. Does it make sense to you? What are your plans? How do you feel if you're in this market? You should be hedging yourself or taking advantage of the current situation. I don't know. Look, like I say, I got your back. I really, really, really do. And I know you got mine. Let's stick together. We're going to get through anything. Anything they want to do, let them do it. Let them do it, and we will sit back and freaking laugh at it. Because we're freaking invincible. Love you a lot. Please share the video. Again, please comment. I'll read the comments. And I will see you in the morning. I'm out of here.